World Development Report 2014, Risk and Opportunity. The private sector's contribution to risk management, with Kyla Wethley, lead author, World Development Report 2014.
A key observation when looking at how people around the world manage risk is that individuals can be very good at managing shocks that are small or idiosyncratic, but can really struggle when shocks become large, systemic, or sequential. And in those cases, they need to share their risk management with other groups, from households to the international community. In this video, I want to focus on the role of the private sector, the enterprise sector, and financial system in particular, and look at how they can contribute to people's risk management. If you think about individuals who work alone, say a street vendor selling food, if that person becomes ill or injured, they may lose their whole day's income. However, when people work in multi-person firms, someone else can step in to perform that role so that that day's income is not lost. In this way, multi-person firms can provide a means for people to pool risk together. However, when we look at evidence from developing countries, we see, especially in South Asia and Sub-Saharan Africa, that self-employment is all too prevalent. Too many people work alone and therefore don't benefit from the risk sharing that can take place within firms. At their best, enterprises can also provide important worker, consumer, and financial protections. However, we see that they often fail to do so. A stark recent example of this is the tragic garment factory disaster in Bangladesh, where a failure to abide by building codes led to the collapse of a large factory, killing 1,100 people. So the challenge for government is to set and implement appropriate regulations that help enterprises to manage risk at their best without making regulations so burdensome that they become a disincentive for firms to be in the formal sector. Another important characteristic of enterprise sector risk management is flexibility. Firms can respond better to shocks when they're more flexible. However, to protect the most vulnerable, including those undergoing labor market transitions, it's important for that flexibility to coexist alongside social safety nets. In a previous video, you heard about Denmark's flexicurity system that combines flexible labor markets with strong social safety nets to protect unemployed workers during labor market transitions. In a forthcoming video, you'll also hear about proposed reforms to social insurance programs, which aim at trying to improve the coverage and sustainability of these safety nets without placing undue burden on firms. In fact, flexibility and formality often go hand in hand. When governments provide attractive public services alongside appropriate regulation, firms are able to be more flexible, and it's also attractive to be in the formal sector. Turning to financial systems can provide extremely useful tools for managing risks of varying size, frequency, and intensity. Personal savings and credit can be really useful for managing small shocks, which also tend to be the most frequent. But those savings and access to credit can quickly be exhausted when shocks become larger, and that's where market insurance has a particularly important role to play. For shocks that are so large and unusual that even market insurance won't cover the losses from them, there's a very important role for government to play in provisioning for systemic risks. However, we see that in many developing countries, people simply don't have access to those important tools. Over 70% of people in low and middle income countries don't make use of savings tools at all, and more than half don't borrow. Moreover, we see that in low income countries, there's a much greater tendency to use informal savings and borrowing than formal savings and borrowing. Governments can help to improve financial access by improving the infrastructure for payment and security settlement systems, by implementing well-designed financial education programs, and by improving data on financial access that can help identify critical gaps in financial inclusion. All too often, however, financial systems are themselves a source of risk. In the past 3 decades, we count 147 banking crises across 113 countries, implying an average of more than one per country. In many cases, these banking crises are preceded by unusual growth or concentration in credit. So in the World Development Report 2014, we advocate for macroprudential policies that help prevent people from becoming over-indebted and slow credit growth during booms. In fact, there's actually a two-way relationship between financial inclusion and financial stability. By increasing the depth and breadth of deposit bases, increased financial inclusion can improve stability. However, when inclusion becomes excessive or irresponsible, as was the case in the US subprime crisis, it can endanger stability. And that's why, as you already heard in a previous video, policies are needed that take the synergies and trade-offs between financial inclusion and stability into account.